Hello guys, welcome back to another video. So in today's video I'm going to be explaining everything you need to know about the options analyzer, and I'm also going to be showing a clip of Mr. Russell explaining a very important concept of the options analyzer. Okay, starting out, first we need to get a very clear concept about the H and the L. Okay, here you guys see we have these L2, L3, L3 right here, L1 right here, H7, H6 values right here. So basically, how are they calculated? How are they formed? We'll be using a simple example. See here, below the pivot, this pivot right here, which is the neutral value, we form two aggregations, basically two daily candles. Right here we are at the daily time frame, right? So basically two daily candles below the pivot form, right? So that formed AL2, right? As simple as that. For above the pivot, here you guys can see this example. We formed one, two, three, four, five, six highs above the pivot, so we formed AH6, right? We also saw another candle, but it did not register as H7. Why? Because it did not give a breakout above this candle's high, so it was not registered as another high. Okay, as simple as that. So I hope that this concept, very simple concept, was clear to you guys. Now we're going to be using the options analyzer, which is the second option after the periscope. Beautiful. First of all, I'm going to be explaining these two charts right here. Basically, it tells you the probability of forming highs. Uh, this one shows you the probability of forming highs above the pivot. This one tells you the probability of forming lows below the pivot, right? For example, let's just say we formed H1 value. Okay, now you must be wondering that, okay, so what's the probability that we'll see another high tomorrow? Well, the system calculates it for you. The system is telling you we have 63% probability of seeing another H value. It means that we are going to see another H2. So we have the 63% probability of that. Let's say we also form that. Now after that, what is the probability of forming H3? We can also make out that 40%, right? As simple as that. Nothing complicated. Okay, then moving on, we have the probability for below the pivot, right? Let's just say that you formed the ticker formed L1 value for the daily time frame, wave 1, 200 days to load, right? Now you must be wondering, what is the probability of forming L2? Well, it's around the 52% value, which is just near to the 50%, so that is not playable, right? So what's playable? Well, after L2 is playable, because for L3 we only have 18% probability. So the system is telling you, okay, for the next day we have 82% probability of seeing H1. So basically here the system is screaming at you that next day we have probability of forming H1, 82% probability of seeing H1. So yeah, well, your bias is decided for the next day. As simple as that. The system makes it so easy for us, right? Well, now we're gonna be talking about this thing right here. This is a bit complicated, so I'm gonna be explaining it very slowly so that you new guys can actually understand it clearly. Okay. Now I want you guys to look at this. You guys see these bars right here? Basically, these are highs that are just represented in this form, taken from this chart right here. Basically, just let me zoom out. See here, the system is showing you the order of these HNLs. For example, see here. So yeah, we formed the H7 right here. So next the system actually told us that we should have formed L1. Well, yes, we did form it, right? So it just orders out all these highs and lows in the form of these bars. Well, you must be wondering, how is that even useful to me? Well, now you just gotta sort this histogram, and I'm gonna be showing you something really, really cool. Okay, let me just fix this. Yeah, see this now. Well, let's just say that, okay, we formed H1, right? We formed H1, and now you're wondering that, okay, the H1 actually formed near the 20% band. Now you must be aware that 20% bands means that we have 80% probability of a reversal. Well, now you gotta figure out that will we see any kind of reversal or not. You can actually use the percentage here. Okay, so let's just use the 3.5%, right? You see that blue thing right there where 473.33 slash 3.5%, so we can actually just look for that on this graph. Okay, I'm going to be looking for 3.5% and see here very carefully that what I'll be doing. We have the total highs as 43, right? Now I just need to look how many highs did we actually see about above 3.5%. Let's just count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 highs above 3.5% above the pivot out of 43. So that should give you the probability around 23%, I guess. You guys can actually just figure out the percentage yourself. It should be around 23%. Okay, so you can actually use this data in this way too, so it's actually very useful to actually figure out your bias. Okay, another thing I want you guys to see before Mr. Russell explains a very important concept about the options analyzer, I need you guys to actually just figure out this panel right here. Okay, so basically we can actually use the options data to actually figure out the daily close price, actually can figure out a range for that. So basically we can actually choose what data set we need to use. Okay, we have the pivot value 471.07, new pivot 448.75, which will be the vector, right? The vector actually forms the pivot. Okay, so basically it is the in future pivot. Okay, we actually can get the value of that. Now we can actually use the current price as the pivot that we should be using because it gets us more resolutionized data. Okay, so we need to use the current pivot most of the times. Sorry, the current price most of the times. Okay, now you can actually also use the yesterday's close price here. This is the weekend I'm recording the video on, so basically it's the previous day close price is this only for Friday, right? So on a normal day it should show, for example, let's say that you are on Wednesday looking at this data, so here you should see the Tuesday close price coming up in the form of a pivot. Okay, most of the time, again I'm going to repeat, you should use the current price as the pivot to actually get out the options data right here to actually predict the close range for the day that Mr. Russell will be explaining now. Okay, so let's move to that part of the video. Thank you so much.
I've got the puts and calls, right? So I've got the puts, got calls. So as we go up, more of the calls become in the money. And then as we go down, more of the puts come in the money. So if you're a market maker, and you're trying to keep all the money on the premium side, you kind of want to be near zero. so that there's little to no gains on the contracts. So what happens is, as buyers, this zero line changes. So if this is 0, as buyers come in, they're distorting where 0 is. So sometimes 0 is up here. 0 can move down. And people use gamma to try to figure this out. I just use the option analyzer because it just, shows me the number. I have it, what's a little quirky is I have it on the spinner in 0.1, tenths. So as you're moving up and down, like it's not running through every single number. But so what happens is, as you go up, more and more of the contracts come into the money. So then as you go down, more contracts are worth money. Well, the CBOE found that, and I use this to my advantage. You can use it to your advantage. 80% of the contracts or more expire near worthless. An expiration. So that defines a range for us. That's like, whatever that range is, right? So let's say this is that 80% range. I'm gonna change a little bit because today I look more like this. So let's say this defines the 80% range right here. So the 80% would be underneath, leaving our 20% here that are profitable by a penny or more. And that profitability comes in over here as the buying and selling's coming in, where it's distorting the 0% line that they're trying to take it to. For example, let's say a ton of buying happens down here, then it pushes our range up a little bit because there's more debt down here. There's more risk because when they're selling contracts, they owe you stock if you're in the money, because you can exercise the contract and say, give me my stock. So somebody over here has got to come up with the stock that's collecting the premium. So there's a rider over here that is in debt, like they're in debt to the buyer of the contract. So, because it's a debt instrument, you sell it and you try to collect premium. So the buyer has small risk. These guys have a lot of risk. If you got to buy stock that's like $200 something and you got to get 100 shares of it, and you don't have it because you're naked, because you're trying to scam people all the time and take their money. It's kind of like the Citadel situation with GME. They were just selling, they were shorting, selling contracts. They didn't have the stock to back it up. So they start squeezing. It's a mess because they got to start buying it to cover their debt obligation over here as the rider. And selling stock, it's the same thing, right? They're in debt. They don't own it. They're borrowing it to sell it, to go short on it. So it's a debt instrument. So that's why, you have a margin account and do that stuff. So what we're trying to do is we're trying to figure out what this range is and about where the close will be. And in doing so, I came in here around 115, 120, I think. I can't remember. Somewhere in here. I checked the option analyzer, and I'll show you how that works. And I was able to figure out that this box represented where the price action was mostly going to hang out, that we were going to be stuck inside there. And yeah, we did leave here for a minute, and then of course, it reverts, hops back up in. So, which led me to bring in the 303 earlier, because as we start to leave it and bring in this 303, which is kind of close, still kind of right in the bottom of the box here. And here was another support line, that white line. So it lets you come in and do this kind of stuff. And I did this like on AMD on Friday. You can find any stock to do it as long as they're liquid. So in order to find this box, kind of the high and the low, I come into the options analyzer, I load up the data, and I pick the expiration date, because February 10th is not so critical as February 6th, the one we're trading for 0 DTE. So I come in here and I adjust the spinner. And so you can see the contracts that are losing. Shows 165, only about 11, which is 6.3%, which is this stuff right here. So if you could buy it on the bid and sell it at ask, it's turning these profitable. And everything from there all down has a partial or full loss. Only these few contracts here. And they don't even work because of the bid and the ask. But earlier in the day, came in here like at that 1 to 1:30 p.m. and I pushed the spinner up and down. You can see how, okay, so you could pick pivot or whatever, it doesn't matter. Current, doesn't matter. But you need to hit this to clear it out. When you hit that to clear it out, as soon as you hit this up, you can see all of a sudden they start jumping into the money, start becoming valuable. I hit down, see all of a sudden, now there's a little more leeway on the short side. That's why it takes a couple more clicks. What I did was I came in here and I found where the top was before we got into this 20% number. And then I found where the bottom was. Right now it's like we're right at expiration. So any movement starts to bring these in and out of the money, up and down, because we're synthetically saying, what's the cost of the QQQ in contrast to what we could get into the option for. So if we could buy this option at 734, get a little bit of bump up, you can see what starts happening. It starts impacting our bottom line. It starts bringing us into the money fairly quickly. So 0.6% makes that be at 28.2. When I click this to sort, look at that. So this one, these things start to come radically in the money. So for a few bucks, for almost no money, really, $1, $2, $3, $4, you can control 100 shares of stock that they would technically owe you. We could sell the contract for $1, we get an 8.8%. So they can't have that because this is tremendous risk. So, the guys that'll be doing this on a lot of stock and stuff, they're the ones that probably have like a lot of inventory and they're selling it out of their inventory, writing contracts against their inventory, or they're doing them naked, or they don't have anything to back them up. But, they'd have to go buy off the open market at ask to get the stock because they have to settle up today at the end of the day. So if this makes sense. So what we're trying to do is we're trying to probe this up and down, and I might put an automatic button in it. I've just always done it manually because I just know what I'm looking for. But so I might put an automatic button underneath. I haven't brought my landscape over, so I might just put an automatic button here, and it'll figure that out for you. It'll define the levels and say, the market needs to be between here and here if I bring that over. But right now what I do is, and what I've always done is I just kind of click up, click down, and I'm looking for that 20% number. I really don't want to see more than 20% of the contracts come into play here on any type of gain. So this is bringing in puts and calls. So it works both going up and going down. When I go down, so I can go down quite a bit before I get to 20%. And the reality is what's happened here. They're trying to keep the number as close to zero as possible, so it's at 5.7%. There's an idiosyncrasy with option pricing and stuff compared to the stock price. And it's this, there's always this bid-ask spread maintained. Because of that maintaining of spread, you never truly get this to zero, the number of winning contracts. The only way that'd get to zero is if the bid and ask collapsed to be the same price. And as you move through, you'll see that it starts to become closer and closer. There's idiosyncrasies like that one. They should be a lot tighter than that. But what they're trying to do is trying to bring this so that based on these reference points, the contracts are close to unexercisable as possible. Because over here, they're just trying to manage the risk. So, so if that's kind of making sense. So tomorrow we could do, we did this in real time today during trading session, to define it here. Tomorrow we could do the same thing during a trading session. You could do it here and on a couple other stocks. We could find where that level's at. So
what time do you typically look for that? Because if you're trying to figure out like how many, or like to get it to the point where only 20% or less are winning contracts, what time throughout the day do you look for this? Because like if you look at it in the morning compared to, say, what time do you do today around 1?
Okay, so I'll give you an example. Last Friday for AMD, the night before, and I was able to collect quite a few points off that. I'll show you what that looked like. Here, since we're 0 DTE, so you have to do it running into the contract's expiration. Because when you can do it way ahead advance, like we could do it today, Monday, for this Friday. It's just that as the week progresses, there's more buying and selling of contracts. We don't know exactly where the contracts are all going to lie. Because, like, let's say somebody comes in on AMD. Not trying to jump around too much, but okay, so since this is a weekly, say somebody comes in here today, they buy like, 10,000, 20,000, 50,000 contracts at $85 calls. Well, whoever's selling those contracts, and it's usually more than just an individual, because for that level, it needs to be more like institutional. It needs to be like a Citadel. It needs to be like somebody that has a lot of money behind him, has a lot of stock, or has a capability to manage selling all those contracts if they go bad. Citadel did not manage it with GME, but I'm just saying they should. So if they sell like a boatload at 85, 50,000 or something, they have every reason in the book to keep this under $85. They're on the hook for millions and millions of dollars in stock, in shares of stock. If that happened Monday, then probably we could come in here if we were watching our option flows, volumes, and we saw just massive buying or selling. We could then use that to calculate where it needs to be on this Friday. ending that, like let's say it's penny ante stuff coming in, 100 contracts here, 200 there, maybe 500 here, 50 there. That's not enough contracts. It's like not enough imbalance in the market. Calculate out where this needs to be. That's why in AMD, when I did this trade last Friday, Thursday evening, or before Yahoo cleared out the bid and ask. So I waited till Thursday evening, and then I created, I don't know where it's at. Here. Okay, so I still got the stats in. Here was my 20% line from AMD Friday. So if we started getting above these lines right here, that meant that more than 20% of the contracts are starting to go into the money. Here was my 9.9% line. If we got below this 9.9, now more than 9.9% of the contracts are starting to go into the money. Here's 11.9. When we were trading that day, I didn't really bother recalculating these numbers. I just knew that we were going to be down in this lower area because it's got to run away from that 20%. That was big liability for some company, institution, or whatever to get above that. Because then if those call contracts get exercised, they're going to have to come up with a bunch of stock. So our, probably around here represented more near zero. But what happened on Friday for trading, I took this first thing in corn in our challenge account. He bought, I had him just buy one put here. He's running the account, so I wasn't sure what was going on there. I bought one put there, and then we sold it down in here for a gain. And I shouldn't say this, man, but if anybody ever goes hot and heavy, using this stuff is the way to figure it out. So if, like, let's say you're trading a small account, you're like, man, I want to go a little overweight, not too crazy overweight, but just a little bit. Having these numbers helps because we know that we can't really get above this line on Friday because it's expiration. So there's going to be problems. And we got to start to work our way down towards more of this 0% line. I just stuck in the 9.9 because that's what I did the night before. I just split the 20% in half. So that brings us back to the QQQ today. So since we're using 0 DTEs for this, I went in there. I could have done it earlier in the day. It's just that I think, on this 0 DTE for these QQQs and the SPY, I kind of wait for it to move through the day a little bit because people are buying and selling here. We can have 20,000, 30,000 contracts at various strikes change hands. So we kind of need that volume to start coming in to help guide us. That's why I kind of waited till this time frame to figure it out. On the weeklies, like the night before is fine. So I'll do it the night before. On these, since everybody kind of is jumping on the bandwagon, I'm kind of waiting till we get into the trading day. And if there was an indicator set up, I've got them, but I haven't pulled them over here. If there's an indicator set up that shows our volume working like this, so it depreciates volume. It's like, let's say our normal volume is let's say our normal volume on all our contracts, it's 100K volume. So this is beginning of day. And here's end of day. So as we're burning our volume off, burning our volume on this line. So like maybe here's like, 1300 p.m. hours. The numbers that we get over here become better and better by hitting up and down because there's less on average. If this was average volume of contracts, if 100 Okay, 100,000 contracts is average. As we burn through here, we start to have less and less to become traded. So our, this would be variable X. So our variable X, which is the unknown variable here, starts to become more and more known because you have more and more contracts traded. So statistically speaking, we start to have less and less price deviation. It starts to become locked in more and more because these are having less and less bearing on the market, on the outcome of the QQQ price. If over here we're running our QQQ, we kind of have our opening price, and then we have our closing price for the day. So these options have a great bearing on the market because especially when there's more and more traded all the time. So as this price is, kind of here and kind of here and coming down here, our options analyzer can start to go more and more in on what's remaining and like what that channel can look like. Because we need to keep, 80% or more contracts worthless above and then the 80% below worthless. And what we want to try to do is move it to 0% over here, our price. So if right about here was our 0%, that's where, ideally market needs to go. Because all those people selling that premium, man, they have a vested interest in keeping that money day in and day out. So this is kind of what we did today. Came in here. I'll just make it up. Say it was 13:15 p.m. That's what I did. I came in here around 13:15. I probed up and down on my button and tried to find this top line and this bottom line where we're kind of within that 20% range. So if right here, the center of that area, that means we've got our 20, 80, 20, 80 below. Because statistically speaking, we know the CBOE did their study and that they found 80% of the contracts. So, so that's all we're doing. Using this to probe up and down. Where we start to get, right here we have 30.7 in the money. Go down 27.8 in the money, 5.7. So hopefully that kind of makes some sense. Yeah. So tomorrow we could do it and then we could see where we're kind of at again. It gives a great idea because here's what can happen too. And this is what I do. It's kind of hard when I'm talking live stream. So I'm kind of giving up money doing this sometimes. But when we get to the top here, we've pre-calculated that. We can wait and see if it holds. And our objective, our goal is to get back down to the bottom. And you can see how that worked out today. Here we are at the bottom. We ran to the top, got to the top of our channel, ran back down to the bottom. So it can give you contracts and prices to look for over here. So that can kind of work, be advantageous. And you just want to make sure too, like it is holding. I kind of waited a second just to make sure, if some weirdo news is coming in or whatever and it's driving it up and maybe the statistics are not as useful right this second because something, but here it was just a normal move. And we did break out a little bit below here. I was a little surprised that it broke out so much, but then it turned and, kind of had to finish up there. So that was another opportunity. Came in and pulled out the put 303 here. Because I was like, well, chances are, And I didn't do a new calculation. I was using my old calculation to build the box from this time frame back here. But I was like, chances are I'll probably get back up in there, which we did. So that's why these puts can come into play. So it's kind of a lot of stuff to check continuously, but it's kind of worth it, you know. You can find good areas to trade off of. And like I said, you really want to do it on the 0 DTE stuff. You got to be heading into the expiration. And like I said, on the weeklies, you can do it, you know, the night before Friday when it expires. You'll get pretty decent numbers. And what you really want, and the reason I traded AMD last week, and I checked quite a few of them. AMD was one. I really dug it. Was because of this discrepancy. There was a huge difference between this 20% line where 80% marker is up here versus down to here. When we came into it, I was like, oh my God, this is so exciting because it's really rallying up. Like, I'll just wait. It worked out because of this huge range. So the bigger the range, the more you'll want to pay attention to that particular option, that stock, those potential contracts.